Welcome to Remarkable Retail Podcast, the 2026 predictions episode. I'm Michael LeBlanc.
And I'm Steve Dennis.
On this episode, we are back with our annual and popular provocative predictions episode for the retail year ahead of us that is 2026. And we'll get to that segment right after the retail news of the week. And then after Steve's predictions, we'll talk about what we're finding remarkable this week and what we're keeping our eye on around the corner in this dynamic industry we call retail. Now, Steve, I'm a big fan of lifelong learning. It's one of my favorite things about doing this podcast. I know you are as well. In fact, you just contributed to the vast library of knowledge with a Leader's Leap online course. Tell the people about it.
Yeah, partnered with a company, courtesy of my publisher, to do an e-learning module, or set of modules, really, for Leader's Leap. So easiest place to find that is on Coursera, or Coursera, I guess is probably the right way to pronounce it. So just put Leader's Leap in the search bar and it should come up. And it takes about 2 hours and 45 minutes to go through. It's got modules for each chapter, essentially. Nice. So it's a good way to learn about the concepts in the course and kind of tease it out through some study questions. So I think people will find that pretty interesting. So go check that out.
All right, let's get to the news of the week. Busy week. The day has finally arrived. The can has been kicked down the road for the final time. The U.S. TikTok deal is done. Tell people all about it.
Apparently. Well, folks might remember that the U.S. Congress actually outlawed TikTok, essentially. And then the new president decided he wasn't cool with that and kept extending.
That being the Constitution, or that being the outlawing of TikTok?
Well, it turns out we're not, laws are more guidelines than things you actually have to adhere to, apparently.
Like Montreal drivers, like driving in Montreal.
The TikTok deal got kicked down the road, but now it appears to be a done deal. This can be potentially quite significant for U.S. retail, at least in that I think we all know that lots of products, lots of retailers get discovered or better understood on TikTok. TikTok shops are becoming a more important transactional place for retail. And just in general, the culture is influenced by things that go viral on TikTok. So what we need to see, I guess, is really what this venture will look like going forward. In particular, one of the things some folks might have seen is a lot of people are noticing the new terms and conditions and some of the privacy things you're agreeing to, which include things like they're being able to use information like your immigration status and your sexual orientation. So I think for very good reasons, people are concerned about that. So we had the prior concerns, which is that TikTok was owned by China or directed by China, let's say, technically not a Chinese company.
Thumb on the scale kind of thing. Yeah.
Yeah. So I guess, and the people that own it are very much aligned with the Trump administration. So there's a certain amount of suspicion as to how things might change and how the algorithms might get influenced. But I guess time will tell. But a new chapter for TikTok, and we'll have to keep close eyes on it and see whether these controversies subside or there's anything really to get terribly fussed about.
Let's turn our minds to tariff turmoil, the Iceland or Greenland or island of ice debacle. With Europeans being threatened with tariffs, and so retailers here sitting, what am I dealing with now? So talk about how this all came to evolve this week. I mean, the week moves fast. A lot happens in a week, but what's your...
The problem on many of these things is, we record something and then 10 minutes later, something different has happened. But as I was making my notes for the week, I thought we might be talking about the tariffs that have been imposed on many European countries by the Trump administration because they weren't going along with his Greenland land grab. Apparently now, once again, he being Trump, did his famous taco trade by claiming that a concept of a deal has been signed, though that apparently is news to Greenland. So anyway, who knows by the time people...
I'm not sure NATO can negotiate for Greenland.
Yeah,
let's not get all geopolitical here.
Yeah, I imagine people are either so fed up with this they're not paying attention, or they know exactly what we're talking about. But anyway, the net of it is it doesn't look like there will be incremental tariffs on NATO members, essentially. But I think it's just another example. And again, we'll talk about this a little bit in the predictions of just the volatility and impulsiveness of the administration. And so we're toing and froing on these issues, which of course makes it very hard to plan for the future when the whims of the president can cause significant disruption. And then 2 days later, 2 weeks later. So anyway, current state, no new tariffs, but again, by the time you listen to this, maybe it'll be some other issue. We'll figure out some country to be mad at. The other thing, a couple quick things on tariffs that some people might have seen, though didn't get as much news coverage as I thought, is that as we talked about, I think for a couple episodes, we're waiting on the U.S. Supreme Court to rule on whether some of the tariffs that have been imposed are legal and might get rescinded, and there might in fact be rebates. Well, that decision has been delayed at least a month. It did not get announced in this month's ruling, so that means it could happen next month, but it could also get further delayed. So anyway, we're on hold for a few more weeks there. And then the last little tidbit is Andy Jassy, Amazon's CEO, who has mostly been saying that tariffs weren't such a big deal for them, or they didn't think they were going to be significant. He says that they're starting to notice price increases creeping in to what they're charging. Now, of course, Amazon for first-party sales get to set, well, not completely, but they have some control over prices, say, of their private brands in particular. On the marketplace, their partners would be setting the prices. So I'm assuming it is both prices that Amazon's able to control, that they're raising prices to try to protect their margin, but they're also seeing their third-party marketplace partners raise prices as well. So given how important Amazon is to I think Amazon's 7% of total retail sales, something like that, and more than 50% of all e-commerce, that is definitely something that could be moving the dial.
All right, let's turn our minds to the last story. Interesting things are happening at the Gap, a chief entertainment officer position. Is this a new experience on the Gap floor? Are we all going to be dancing in sync, like line dancing or something? What's going on here?
I'm not sure this is very pointed at their stores, but yeah, they first retailer that I'm aware of. Dear listeners, tell me if you know of otherwise. But they created a chief entertainment officer position. And best I can tell, this is really, I think, the role is meant to think more broadly about the intersection of media and retail, which I think we're seeing more and more. It's also appears to be related to licensing of their intellectual property, which, fun fact, that's what my dad did for a living. So I don't know that he was a chief entertainment. Well, he wasn't a chief entertainment officer of any retailer, but he was in the licensing business in the motion picture and entertainment industry. So anyway, that was quite a while ago, of course. But I think it's really interesting. I think it speaks to the intersection between media, culture, retail, and clearly the Gap has been, some of their advertising is over the years, over decades, but also more recently with their Cat's Eye promotion, where you see this intersection between various types of entertainment and what's going on in their marketing. So, but it also speaks, I think, to retailers looking for other ways to enhance their margin, because so many don't really make that much selling their products, but they're making money with retail media networks, maybe with membership, with other kind of collaboration. So, yeah, I'll be curious to see. Imagine this person's not going to come in and do nothing. So we'll see what she gets up to. So I think it's an interesting thing to watch.
All right. Well, that's a wrap on the news. Right after these messages, Steve's 2026 retail predictions, then remarkable stories of the week, and looking around the corner right after that. So stay tuned. Promotional support for the Remarkable Retail podcast is provided by Crave Retail. What's retail's biggest blind spot? The fitting room. A shopper wants to buy, but can't get the help they need. That's why global brands partner with Crave Retail, the market leader in smart fitting rooms. Crave connects that moment to your business, giving shoppers a voice, associates real-time alerts, and teams the data to buy smarter. The result? Higher conversion, better decisions, a seamless experience. Learn how fast you can elevate your fitting rooms at craveretail.com. If the world has changed so very, very much, why have so many organizations changed so little? As the pace of disruption accelerates, leaders need the courage and the insight to aim higher in the value they deliver, move faster than they ever have before, and take the bold action to leap ahead of the competition. With Leaders Leap, Transforming Your Company at the Speed of Disruption, Steve's latest breakthrough bestseller, you'll discover why so many companies fall into the trap of the timid transformation. More than anything, you'll learn about the essential mind leaps leaders need to make to win the future. Leaders Leap is available just about everywhere books are sold, as well as on Audible and as an ebook on Kindle for just $9.99. You know, when I do presentations to groups of people, the thing that seems to startle them the most when I talk about retail growth is the concentration of that retail growth. Like, it really strips back a whole lot of assumptions. And you've been talking about this, we've been talking about this a while, and it dovetails into your second prediction.
Yeah, the second one is what I've started to call the great concentration, because, you know, there's always got to be the great something. So very, very prototypical here. But the great concentration will continue. I don't think we're going to see any lessening of sales growth among, in particular, the big three retailers in North America, at least, Amazon, Walmart, Costco, but also I think kind of the next tier, which is mostly off-price dollar store guys, that will continue, that the majority of incremental sales will be captured by these big players. Also think it's going to be profits. And in fact, I think in general, if you were to study the average profitability of these big companies on a rate basis, it's better than average as well. So we often talk about sales, but it's profitability, which of course creates this flywheel of being able to invest in infrastructure, being able to invest in price, so to speak, you know, being able to keep prices down when others may be forced to raise them. I think we may see some moderation from the off-price guys. I still kind of wonder how high is up there, but I suspect they'll have very good years. The other thing which is worth paying attention to, which doesn't get as much attention, is the relative incremental growth captured by the big guys in e-commerce. And if you look at Amazon's growth rates, significantly above average, Amazon growth rate, or Walmart's growth rates well above average, Costco's well above average. So we're seeing quite a lot of concentration in e-commerce as well, and a lot of big players seeing very slow growth in e-commerce. So that's pretty interesting. So it's very difficult if you're kind of in that second tier to keep pace. So this is another kind of collapse of the middle thing that I think is going on.
Well, building on that, or a nice segue into the third prediction, which is really based on, you know, if there's tremendous success happening with a few retailers, it means there's a lot of retailers who are effectively struggling and perhaps in turnaround mode. Right. So talk about how you are thinking of that for 26.
You know, as I try to reflect back on 3 decades in the retail industry, there are always turnarounds going on, right? And we've all seen that. So that's not particularly unusual. But I do feel like there's an unusual number of a kind of iconic brand turnarounds that we're in the middle of. And we've talked about all of these to a certain degree over the last year or two. So my general view is that the big retail turnarounds will be quite a mixed bag. When by that, I mean, we'll see some traction in some and much less so in others. So just to kind of name check a few of them, I'm pretty confident that we'll continue to see meaningful traction at Gap. We just talked about them. I think Nike will surprise maybe on the upside. Not dramatic, but I think we'll start to see meaningful progress there. Macy's, I think, will be kind of better than some of their direct competitors, but still nothing really to get terribly excited about. I'm much less optimistic about Target, not that they can't improve over the much longer term, but I think they're so far behind. And for them to have real progress, they're going to have to win back some meaningful share from folks like Walmart. And Walmart has just become so strong that I think that is a big uphill battle. Easy.
We're at prediction number 4. We haven't talked about AI yet in any real way, other than a bit of context. So what do you think about AI this year?
Well, you know, I always want to have a prediction that has a tie to a Canadian. So I'm thinking about Alanis Morissette's song, Isn't It Ironic? Which I think by now everybody knows that song actually doesn't contain any irony, which is ironic itself, I guess. I don't know. It's all very circular. But anyway, I think this is a very agentic year. So I call this the "and isn't it agentic, don't you think" prediction. It's hard not to think about the degree of innovation, really a breathtaking pace of introductions and collaborations. We've talked about some that occurred last year. There were a huge number just at the recently completed NRF show. Search is changing very rapidly. The potential for disintermediation, I think, is very high, and I suspect we will see both efforts that will lean into creating the disintermediation, and of course, the folks that are worried about getting disintermediated will take some action. But I think it's going to be a real slugfest for leadership. We've got obviously Google with Gemini, but OpenAI, Claude, et cetera, and a huge number of startups. So with all these big players with enormous resources competing for hegemony, and then hundreds, if not thousands, of startups trying to get some traction, I think it's going to be just a crazy year. I don't think the path forward will be super obvious by the end of the year, but I think that just the degree of new stuff that we're sorting through is going to be quite overwhelming.
Let's move on to number 5. Stores matter more, but also less. So that's an interesting title. I love stores. I just did my NYC tour of stores, and boy, it's just such vibrant things happening. But at the same time, there's a push and pull on their role and the meaning of their importance, I guess.
Yeah, again, this gets a little bit bad. I mean, I should have a prediction of the death of averages because, I go on about that so much. But, when people say, physical stores are back or physical stores are in trouble or whatever, the answer is that there are plenty of physical stores that are doing great. There are plenty of physical stores that we have to question why they exist. So when I say they matter more in very specific circumstances. In general, for most brands, stores are the hub of their brand ecosystem. They're the place that's the fullest expression of the brand, where you really get to experience it in a more relational way rather than a purely transactional way, right? It's where a lot of customers
I think of a Tecovas, for example. I think of,
right. And so
you walk in that store, they're not going to replicate that online.
Yeah, there's an emotional connection. There's things that you can just do in a physical space that you can't do online. So I think, and for the most part, if you look at most successful brands, obviously Amazon, eBay being big exceptions, they're still brick and mortar dominant. And of course, stores are used for buy online, pick up in store, for returns. And so even something that's e-commerce mostly ends up having a connection to the store. So that really says you got to understand the role of the stores and lean into that. But for sure, bifurcation here is intensifying. There are plenty of stores that are becoming less and less relevant because they don't have a real reason to exist. Because if you're not providing any real differentiation, either, hyper convenient, a place where you can get one-stop shopping or pick up and grab and go, nor on the other, the Tecovas, more specialty brand kind of ethos, then what is your role? So the stores that we were seeing closing tend to be these undefined, very mediocre stores that don't strongly lean into the role that stores can play about either being closer to the customer and very convenient or creating those emotionally connecting. That's why I say for the right brands, you want to lean into your stores because you can provide the more elevated, amplified experience that really solidifies the brand. For others, if you can't find a role, then you're going to be pulling back. You're going to be disinvesting in your physical stores.
One of the things that surprised me, and being like yourself, long tenure in e-commerce, I thought premium, same day, same hour delivery to the doorstep was always going to be a niche. But it's not turning out that way. It's finding it's a real role in e-commerce and retail experience.
Well, this is another place where they're kind of clear winners and losers, and a lot of this has to do with their scale. So this one I call the race to the doorstep reaches new heights. And of course, over the last few years, everybody would be aware, it used to be that 2-day delivery was a premium kind of experience, and it still is for many brands. But when you look at Amazon, you look at Walmart, 2-day kind of became the norm. 1 day even more so. And now we've got just a lot more same-day delivery being available now, often for some premium or a minimum order. So if we just look at the percentage of orders that are going to be delivered next day or same day, that continues to increase. And largely, this is a battle between Amazon and Walmart and just a handful of others. The other battle that's going on is also the narrowing of delivery windows. This is something I know Amazon has really been working on. So instead of saying afternoon or morning or afternoon, it's maybe getting down to a 2 or 3 hour window. So just, the huge advantages for Amazon and Walmart, because they have these vast networks and the ability to have the product positioned in the market so that actually can be done the same day. That's a huge challenge, but also the efficiency of density of deliveries. So this is where the superscalers really have a big advantage. Or you're left using, say, Instacart, DoorDash for delivery, which is a decent option if you've got inventory positioned or stores in a given market, but it is not a low cost option. So the other thing I think to watch very, very carefully here is Amazon's push into fresh grocery. We've talked about how huge they are in shelf-stable kinds of products, but they are expanding the number of markets and the choices for fresh, frozen product. And that is a big upside for them and people's ability, or their Prime members' ability to get a lot more products same day in a lot more markets is really going to change the equation here.
Number 7 builds on current events, the Saks Global Neiman's bankruptcy, and you predict, I guess it's not really your prediction that they're going to emerge from bankruptcy, but your prediction is about how the business or the state of the business once they do emerge and what that's going to look like.
Yeah, well, I would say it's not a completely foregone conclusion that they will not liquidate, but I would say the odds are quite high that they will emerge. And what I see happening here is that they will come out leaner and meaner and in a position to be a viable business that can be sustained. But I still think they're pretty likely to be fragile. And why I say that is, well, first of all, it's important just broadly, and it kind of leads into the next prediction, so we'll save that in a second. But because of how dominant they are in luxury retail in the United States anyway, it's very important to kind of the whole ecosystem. So however this ends up sorting out will have a huge bearing on the luxury market here. It also have a huge bearing on certain malls and certain high streets where there will be stores, presumably, that are going to close. So it's not nothing. And when you think about the closing of stores and the pullback and contraction of the overall business, my guess is their revenues will decrease somewhere between 30 and 50%. So that's billions of dollars that are up for grabs. So there is going to be inevitable shift of market share to vendors-owned stores, to Nordstrom's, to Bloomingdale's, Net-a-Porter, My Teresa, other players. So that could give a real lift to some of the players that have strong positions. And it's going to be very deleterious, I think, to a lot of smaller vendors that don't have the profitability to withstand losing the volume, and particularly if they don't get paid or get 10 cents on the dollar for what they owe. That is potentially devastating, unfortunately, to those brands. So yes, they'll be quite a bit smaller. They're also doing that at a time where the multi-line department store market is continuing to contract. So they're not exactly, even if they come out with almost no debt and much more productive store portfolio, et cetera, it's not as if they're riding the tide of great growth. And my big question, and the reason why I say they will be fragile, is it's not clear to me at all that they will have the kind of cash flow, even if they perfectly execute going forward, which is not a foregone conclusion, to make the kind of investments they need to make to stay on the leading edge of technology. All the stuff we've talked about with automation, AI, just the normal course of business to keep your technology leading edge. But also, most of their stores have not had the investment they need to be truly modern, and most of them are way too big. And having worked on a lot of remodel projects for luxury department stores, that is an expensive thing to do. To go from 3 floors to 2, that's many, many, many millions of dollars per location. So that needs to be done. It doesn't need it all to be done in the first year, for sure. But I'm not sure that they can given the dynamics of the market and their position, whether they'll really have the cash flow to make this a exciting company for the future. So that would be my worry. So I think, yes, they emerge. There'll be not in peril, immediate peril, but not necessarily a real remarkable brand that can profitably grow for the future.
Let's talk about what you're thinking about luxury's future.
Prediction number 8, which is a little bit related to the prior one, is that luxury's future will not be evenly distributed. Another a riff on something that another famous Canadian said, William Gibson, I believe. The future will not be evenly distributed in general, but there are a lot of folks that are predicting a broad luxury rebound. I am not one of them. I think we will see recovery in a number of places, but more broadly, I don't expect luxury to have a great year. I think where we'll see success will be largely around the brands that have been having success for years. Hermes, Prada Group, parts of LVMH, but not all. But a lot of the other brands that have been struggling, I think will continue to struggle because I don't think the overall, it's not like the tide is going to rise, cause all boats to rise. And the issues that they have in terms of brand positioning and execution, I think will still largely be there. The one exception I might mention that's a pretty significant brand is I do think Burberry is doing some really interesting things and starting to gain some real traction. So that's a brand that I would say has not had a tremendous amount of success in the last few years that I think could have a pretty good year. And then, of course, when you talk about luxury globally, a lot rides on what happens in China. I think, again, we'll probably see some recovery there, but I don't think it's going to be such a strong recovery that will really help the luxury industry writ large.
Boy, I've been looking at some numbers that have been coming out of China around their population collapsing, basically. And this was forecasted for a while, thanks to that one-child policy. And so if there's any growth in China, it's certainly not going to be population growth. It's all going to have to come from somewhere else.
Destiny.
Demographics are very, very important. All right, number 9, resale is finally ready for its close-up. I've been following this for many, many years, been very skeptical that it would ever amount to much, but it seems like the confluence of a bunch of things, whether it's the affordability crisis or just a change of values, seems to be pointing in the direction that, resale is finally ready.
Yeah, I think there's been a lot of conversation around this for years, and I think the excitement about resale was largely tied to younger consumers are very purpose-driven, and so therefore they're very interested in products that are tied to some sort of sustainability story. And that's not turned out to be so true. I think we've learned that while lots of people have certain values in their purchases, they often vote with their pocketbooks. And so it's great to say you want something sustainable, but it's hard to explain the success of Temu and Shein if you think about that or you think about any kind of other ethical considerations. I think what is driving and the reason why I think this is going to be a very good year for resale is the confluence of some factors. It's somewhat the purpose story. I think a lot of it is driven by affordability. It's a chance to get brands that are high demand brands that are out of reach for the vast majority of customers. So you get both the good price point, but you also get the story that makes you feel like a better person. It's also been a challenge for some of the disruptors, the Poshmarks, the ThredUps, the RealReals, to achieve profitability. But many of them have been really working on their business model. And instead of just chasing profitless growth, they've tried to find a balance between growth and profitability. And I think many of them now are in a place where they can drive the top line forward and not put their business at risk. And we're seeing more and more big brands, existing brands, embrace the circular economy model, so standing up their own resale efforts. And so all of this, I think, adds up to making it much more in the forefront of what consumers are seeing, a lot more choices and accessibility to actually participate. And then when you layer on top the affordability issues, I think we're going to see very good growth, and I think we'll see more profitability. One little fun fact, which is not a 2026 prediction, it's something that actually happened, is Goodwill. They had their e-commerce, vintage clothing, used clothing, however you want to think about it, their business grew 22% last year, I think was the number.
Wow.
And it's now like a $750 million business. So, you talk about the Warby Parkers and some of these other brands that have been around for a while and get all this attention. Well, that's pretty much the same size as Warby Parker. And you think of Goodwill as kind of this, not a high profile retail kind of offering. Sure. So, and of course they do have their physical stores as well. So yeah, I think it's going to be a much more exciting year this year than the last few.
My friends in the grocery sector for many years, I guess their entire lives in some way, think about wellness and they think about trends, whether it's protein or fiber coming up or, GLP-1. But you think, and you're thinking much more broadly about these things on the impact overall, the impact of wellness overall on retail. Talk about it.
Yeah, I think going after health and wellness related opportunities is going to be a much bigger deal than it's been in the past. I mean, it's not as if, to your point, grocers haven't sold supplements and other kind of healthful offerings. That's been, I think, part of the grocery playbook. But I'm thinking even more outside of grocery. I think this looking for new growth opportunities, both because of product pressure or profit pressures in their core business, but trying to find new ways to engage customers, to leverage customer relationships they already have, to leverage the data they have, to add things if they've got a membership offering or a loyalty program. So I think there are a couple things that are really, really driving it. GLP-1 for sure, but I'm not talking about just selling more protein-rich, macronutrient-dense products, but it may be offering prescriptions and subscriptions. So we're already seeing Costco, Amazon, and others Walmart really standing up more wellness offering. And then I think the broader thing is longevity trends. So people that are really taking a look more at their metabolic health and things like that. So that is their diet, but it's also selling products that support that. So I think, when you start to think about if somebody, it's really a lifestyle thing. If somebody's a follower of Peter Attia or somebody like that, and all the things that he recommends or any other influencers, what are the set of things that you need, your gym membership, your weighted vest, as well as your diet. That it's much more of a holistic approach to it, and maybe a bundling or a subscription or membership than just simply shifting the merchandise mix, because that's certainly not a new thing, and we've seen some definite trends in the past. So I think this will just kind of raise, and we'll see a lot of new offerings from retailers in this year.
Now, they weren't covered in your turnaround prediction, but when I think of turnarounds, I think of Starbucks, one of probably in the midst of a huge turnaround in their category. You are thinking something about one of their particular tactics that may not work out.
Yeah, this is a very specific prediction, but I think it's an important one to make maybe a broader point. So you're right. I mean, I could have very easily listed Starbucks in the earlier predictions, but I want to call this out in particular. And the specific prediction is that they're going to reverse course on their digital-only stores. So one of the things they decided early in the turnaround under Brian Niccol, their newish CEO, was they were going to pull back from locations that didn't offer kind of the full third place Starbucks experience with ability to sit down and hang out. And the rationale for that was really that's kind of the origin of the brand, and that is the full Starbucks experience. And as much as I'm very much into consistent branding, I think it's a very silly way to think about it, because I think that you have customers, and I think to be overly simplistic about it, there are two very distinct purchase occasions when it comes to getting your morning beverage, or doesn't have to be a morning beverage, which is I'm in a hurry. I want to get my caffeine hit on the way to work or the gym or whatever I'm doing. And then there's, I'm working on my computer, I'm meeting up with people, and I want to hang out. And I think that Starbucks can very easily mean both. And to not want to serve effectively and basically force customers to come in to your store and sit is just a little bit nutty. And the fact of the matter is, a lot of people are coming in anyway, but they're not staying. So why make it harder for them? I just think it's not very customer focused. So I think it's rarely a good idea to ignore the fundamentals of why customers like you and why they choose you, particularly in the context of what your competition is offering. And of course, Starbucks has lots of competition. They have the more third place competition, largely from independent coffee shops. But you have Dunkin' Donuts, you have Dutch Bros, you have now Chinese Lucan coming into the U.S. that are very, very happy to go after that quick service kind of experience. So 2 messages here, I think, which is why I think they need to reverse course. One is just meeting the customers where they are. It's not getting them outside of their core capability. I think is a very understandable customer value proposition. The other thing I think is a broader trend is to see the value in offering hybrid ways of interacting with the brand. So just like IKEA, I mean, this maybe seem like a weird thing to compare to coffee, but IKEA with their destination stores, 200,000 square feet, but then also having these smaller stores which are serving a more dedicated experience that make them more accessible to the customer. So I think when your strategy, you have to think about the different types of customers. You have to think about the different purchase occasions and then pick the ones that make sense. And I think it absolutely makes sense for Starbucks to participate in this fast and speedy access to morning coffee occasion. It's a huge amount of volume for them, and it's a huge dissatisfier, I think, to their core customers not to offer it. So I think we will see a big turnaround there.
In these predictions, I see them online. They put 2 columns together and they say, sometimes hot, not hot. You've chosen tired and wired. So give me your number 12.
So this is my macroeconomic prediction, really, which is that the tired thing is inflation worries and the wired thing is job worries. Not that inflation is not important. I think inflation in many countries is going to remain elevated compared to where we would hope it would get and remain relatively sticky. But I think that a couple things are going on. One is inflation is, generally speaking, quite a bit lower than it has been. It does seem like retailers are working through the tariff, U.S. retailers are working through the tariff impacts relatively well. And I think most retailers have chosen to, quote unquote, invest in price. In other words, not take price increases to try to offset the cost as much as you might think they would, because they want to maintain volume and market share. And there's an offset here, at least in the United States, but I think in some other markets as well, is that gas prices are coming down quite a lot. So they're getting a little bit of an offset, not just the price of gas in terms of what consumers pay at the pump, but of course, transportation costs are very significant to retail. So I think there's going to be a little bit of a hedge against product pricing. But I think the fundamental thing here is that the job worries are going to continue to grow. And I think that's a function of layoffs that will happen because, as we talked about at the top, a lot of the profitability is going to very few players, which means a lot of retailers are struggling. So one of the ways to try to improve their profits would be to reduce costs. That's typically in headcount and stores. The effect of AI, obviously, is something that is starting to happen and presumably will be more intense as the year goes on. And I think one thing that doesn't get as much attention as it should, except other than, I know we talked about Amazon's plans, is the impact of automation. And there's just a lot more automation coming into all sorts of retail, whether it's ordering, you go into a McDonald's, just to use that example, and you ordering from a screen instead of talking to a person, all the way down to the automation and fulfillment centers, which of course is already quite significant. And if you believe what Amazon is saying, they're going to have a lot more automation, and that is going to result in a lot fewer jobs. So I think the narrative is going to much more shift to the job side, and we'll kind of get comfortable with inflation staying in a relatively elevated but not extreme range.
Last but not least, your Baker's Dozen prediction, number 13. And this one is focusing on a little bit of all those things put together, Sephora and Kohl's. What's going to go on?
Well, so folks might know, in the United States, people probably know that outside the U.S., you may not know that Kohl's, which is a major department store which has been struggling, has Sephora shops in the vast majority of their stores. I forget the exact number, but I think it's 85% of their stores. And in fact, Kohl's has often pointed to how successful those Sephora shops are, to the point where it's more like Kohl's at Sephora, I think, because Sephora is so dominant. This is definitely the one that I think is the boldest prediction. I think it's going to happen at some point, whether it will happen this year. But I think Sephora is going to decide they need to hedge their bets and either get out of Kohl's completely, but more likely start to phase out their presence. And this is because I believe, as I said earlier, Kohl's is going to continue to flail. I think it's going to become clear that they're going to have to close a lot of stores. I think there'll start to be growing concerns about a potential bankruptcy, though. I think because of the way, not to get into the weeds on it, but I think because of their debt payments, that's not probably a 2026 issue. Right. And Sephora is just very exposed to points of distribution. And I think they will want to control their own destiny, avoid a risk of some massive sales loss were Kohl's to close several hundred stores. They'll probably the first stores Kohl's will close, less likely to have a Sephora, because Sephora cherry pick probably the best locations. Of course, Sephora knows a lot from their own stores of where the opportunities are. They are in plenty of places where it would not be hard for them to stand up their own store within a quarter mile, half a mile, 1 mile. So now I don't know enough about the nature of the agreement to know how much power Sephora has in this, to do this in a significant way in the short term. So that's one of the reasons why I think it's very hard for me to have a great deal of conviction. But I think the intent there will become quite apparent that that's really what they need to do. And it's frankly not that different than Ulta leaving Target. Target struggling, Ulta, a lot of their own stores, worried about the brand presence. I think one thing that's even more extreme, you could argue, with Sephora and Kohl's is Sephora is a way more upscale brand than Kohl's is. And so I think as over time, it's less obvious why they are the right partnership. I would say now, if you were going to have a department store partner, you'd probably pick, Sephora would probably pick a Macy's or Dillard's or somebody else that's more upscale. Probably the riskiest one here, but that's my story and I'm sticking to it. But that's why it's the last one too. And go back and cut it out if it doesn't come true.
All right. Well, that's a wrap on the provocative predictions for 2026. Now let's get to the stories that we're finding remarkable this week.
Mine is, because it's just a head scratcher to me, is that Lululemon has another own goal product debacle of having what apparently is a see-through product. People may remember that this is the same issue or some very, very similar issue they had several years ago. So you'd think they would be paying attention to this sort of thing, but it gets better in two other ways. One is that their response is the way to solve for this is for the customer to wear flesh-colored underwear. Okay. It's always great when you make a mistake.
I do, but I don't know. I wouldn't have.
I mean, I do anyway, so that's not a big issue for me. But the other thing they walked into, as we've talked about in a recent episode, is that Chip Wilson, the founder and former CEO of Lululemon, who has been highly critical of the management and the board in particular, and that's a whole other little side story. This gave him another opportunity to say, what are you guys doing in running this company? So I think Lululemon would be interested in having Chip he's probably going to do what Chip's going to do anyway, but not giving him another excuse to say you guys are hopelessly incompetent and need to be gone. So yeah, it's a head scratcher.
It's quite a story, and of course, he's also the biggest shareholder. Like he's not just he's not just looking in the rearview mirror.
Not a majority shareholder, though, so he can.
Correct, but he does own a big position, and he's going after the board. And I think there's a there. I mean, to have someone, a CEO of such a major company, depart with months and months of having. There's no succession plan here. I think that's a board failure. For me, it's congrats to recent guest on the show, Chris Nicholas, who was, when we talked to him last year, was running Sam's Club. He, in the new John Furner leadership, is taking over the Walmart International division, which happens to include Canada. So I'll be looking forward to touching base with him. And so Furner is putting his mark on the different people that he wants on his team. And some people are leaving and some people are arriving, but I wanted to give a shout out to Chris. Great interview. If you haven't listened to it, he's such a dynamic leader. Now, what's on your radar screen coming up in the very near future?
Well, this is very much a macro comment and maybe a little bit too inside baseball, but I think paying attention to what's going on in the bond market is really important. It was been quite jittery this past week, largely because of Japan and because of the Greenland thing, just in general worries about uncertainty, I guess. Which puts more risk into the market, which then causes interest rates to go up. But I think the other thing is, and this was kind of a Greenland thing as well, is people aren't paying that much attention to the U.S. deficits. The more deficits go up, the more borrowing the U.S. has to do, which also puts pressure on the bond market. Why do we care, though, from a retail perspective? Well, we care because how the bond market performs often affects the stock market. And so if this causes the stock market to freak out, then people feel less wealthy, they spend less money. But the other thing is consumer interest rates and mortgage rates in particular. And we were talking earlier about recovery in the home market. It's very hard to work out how there's going to be a major recovery in the home market if mortgage rates and home equity loan rates and things like that don't come down materially. And so if you have bond market jitters, that is not going to happen, which means any recovery is likely to be delayed and perhaps quite muted. So anyway, I would just be paying attention to that. It's not a next week thing. I only bring this up really because it's been a much more jittery market of late than it has been for things that kind of settled down for about 6 months or so once people realized that the retribution tariffs were not going to stick.
Well, I'm thinking about the outcome or the knock-on effects of the whole Davos week. And of course, I'm not thinking here exactly of the big speech of the show, which of course was Justin Trudeau showing up with Katy Perry doing a speech on the side stage.
I think you're going to say Macron and his how he's completely driven sales of metallic shades. So
that is my thing. I'm looking on the radar screen. I want to be in the sunglass business because French President Emmanuel Macron made the fashion statement with those fancy sunglasses, which I want to be a sunglass retailer this week. So that's what I'm looking at.
You could be a sunglass influencer. You didn't know that Macron was a sunglass influencer. But yeah, it is funny though to think about how, I mean, obviously this happens, these viral moments that are very unexpected. Yeah. And there you are sitting in whatever that company is apparently a pretty small company in Italy or something, right? And then suddenly you're on the world stage and the demand for your product goes up 30,000% in 10 minutes. So
he probably picked him up in the pharmacy on the way to the airport, right? Like, I just need something for my eyes. I guess he had some eye surgery or something. So,
no, but that again, I mean, we go back to the TikTok comment, right? Like the way some product or celebrity or whatever can become disproportionately profitable disproportionately influential in a nanosecond because somebody happens to say something or feature something and then it just takes hold. I mean, it's a wild world we live in for sure. Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to StephenPDennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.